Hello, folks. Sorat Nation. Today is Sunday, March the 3rd. We're starting that month of March that I've been talking about, so we'll see what's going to happen. I'm going to do 2 sessions today. Zuper's not with me, so I'm running solo. So it'll be some pretty quick sessions, hopefully. I want to first talk about where the market was this week and where it might be headed. So I'll get into that in a second and show you some charts. The second session I'm going to do today is I'm going to break down some of the technical indicators that I use and explain why I use them, how to use them, and what they mean, how they're put together. And that's something that I think I might do on a regular basis, just talk about some technical indicators to help people understand how they work. So that'll be the second session. So let's get into it today, and I'm going to share my screen, and we'll look at some charts here. First, for those who are interested, this is my website. So my newsletter is right here. If you would like to get the newsletter, just click on that button, or at the very bottom of the screen, you can sign up for the $0. This will register your email, and then you'll get alerted each week whenever it's available. If you don't want to sign up, you don't have to. You can just go and get the newsletter, but you'll have to do it on your own because you won't get reminded that it's there. But this is usually there on Saturday, by Saturday afternoon, East Coast time. So, and I'm going to actually use the newsletter today for some of this first session. Let's first look, though. This is the main page. There's no subscription required for the front page. And there's some 5 little charts right here just to keep track of what's going on with the market. And I show the Investors Business Daily current status. This has been the status since February 13th. Incidentally, which is interesting because the market's gone higher since then, but they're still saying 60 to 80% exposure. But let's look at the S&P real quick. So here's the previous all-time high. The S&P has continued to hit higher highs, as it did again on Friday, made it right up to this trend line. So we'll see if it holds there or breaks through it. We still have this negative divergence in play on the momentum indicators. And I've talked about that for quite a while. Talked about that in the newsletter. I'll show you that in a second as well, but it still exists there right now. The NASDAQ looks similar. So NASDAQ continues to hit higher highs, but also has a negative divergence. So momentum is slowly coming down lower, which means the momentum in order to get to these new highs is slowing down. So the market is running out of steam, albeit on a very slow pace. Now, if these broke out and actually started to make new highs, which would have to go all the way back above this one back here to make a new high, that would be very healthy, and the market would just basically blast off if that happens. But I think it's due for a pullback, which we'll see what happens. On that note, let me show you what Jeff Hirsch from Stock Traders Almanac, as most of you know, I'm a big follower and believer in the history of the market. This is what he said. This was actually on LinkedIn. He took 2020 out of the analysis, and what happened was it made it look much flatter. So you can see the one that I showed before has a big dip here in March. But if you take 2020 out, which was essentially that dip was COVID, the COVID crash, then it kind of flattens out the curve going into March. There still is a little bit of a downtrend in March, but not as severe, which is interesting. I'm kind of glad he did that. So, but he's calling for a modest pullback of 3 to 6%, which is exactly what I said last week. If you watched, could be the 4,800 all-time high. It could be, but I don't think it's going to get that low. I think we're going to probably have about 5%. I don't think we'll have 6%. If we look at, I showed this last week as well, but this is what March looks like. This is again from Stock Traders Almanac, and make this a little bigger. And the thing that I'm pointing out here is the percentage loss or gain. So if you just look at it just as the chart itself, then it looks like a very severe pullback. It actually looks like a crash, but it's not. If you look at the percentages, that right there is about minus 3% from the zero line, coming from a 1% higher. So that's about a 4% decline right there. So 4% decline would put us around 4,900, I think. The other thing that's interesting is if you look, this is where we are right here. This is Monday. Monday looks like an up day. And then Tuesday is when this decline starts. So sometime next week, this goes back to 1950, by the way, these dotted lines. So after Tuesday is when that decline might start. Doesn't mean it's going to happen. This might be an anomaly year. This might be the 1 year where it goes higher instead. And it could, but with those negative divergences and everything else that's going on, I think the market is due for a pullback, although I don't think it's going to be a huge one. So let's go back over here and go to the newsletter again. I love this cartoon right here. 1 year clean, and then I run into my dealer in front of the grocery store. My wife sent me this, said this is me. I can't resist Thin Mints for some reason. So anyway, the newsletter has cartoons every week. It shows the economic calendar last week. Things weakened slightly in the economy, but not dramatically. GDP came in lower than expected. PCE, interestingly, came in as expected. So that was good. This week is the jobs number. So we'll see what happens. Jobs are forecast to come in weaker, but still above 100,000. I think it's about 190 now. This will change a little bit, but the unemployment rate is still at 3.7. So I talked about that, and this is the unemployment rate right here. Something to watch for recessions, because normally when they start to spike, then they go up very quickly. And that's what the Fed will be looking for as far as starting to cut rates, I think. And I don't think that's going to happen before June, frankly. So the unemployment rate is the rate itself, rate of change is starting to creep up, but it hasn't spiked yet. So we'll see what happens with that 3.7, if that stays the same or if it starts to move higher. This is something that I put on the website every day. And this is basically just a accumulation of all of the categories in the market. So the indexes, the industries, the sectors, currencies, gold, Bitcoin, commodities, all of those things put together, and whether they are all rising or falling. And what you can see here overall, we have been ever since right here in about the middle of January, the market has just been doing nothing but going up. And the one below it is the day over day and week over week trend, with the orange line being the short term, the gray line being the midterm, and the yellow line being the long term. Long term, as you would expect, is a little flatter, but the short term is definitely going higher. So that's a good news for the market. This actually is the same. This is where all that data comes from. It's this is also put on the website every day. This is updated. You can kind of tell just by the colors how things change. So here's the end of December, went down a little bit in January, turned into green, started to go back red, then went green, and then red and yellow, and now we're back to green again. So we'll see. This one here is really interesting. This is the sentiment chart from the National Association of Active Investment Managers. So for those that have already looked at my newsletter this week, this is a little redundant, but I wanted to show it to everybody because, again, there's a negative divergence here. The S&P keeps continuing higher, but investment managers are repositioning. They are becoming less bullish. And when it gets overly bullish up here, that's usually when the market turns around. That's similar to what happened back here in 2021. The market went higher, investment managers were repositioning, moving from bullish to a bearish stance. And 22 was that long bull market. Now we had the opposite, a bullish divergence. This is why divergences are so important. Right here in October, when the market made a new low, but investment managers were starting to reposition themselves, becoming more bullish rather than bearish. And that was the low right there, and we started going higher. So don't ignore those divergences. They're really important. This is the McClellan oscillator, which tracks the advanced decline lines. And you can see as the market has gone higher, the advancers are fewer and fewer. So you would think if the market's going higher, there would be more advancers, but in reality, there's actually fewer advancers. And same thing with the bullish percent index. Again, that is a negative divergence. These things can take time to play out. That's highlighted here. It can take some time. You know, this one here was basically 2 months for this negative divergence before the market fell apart. So could take some time, so we'll see. Just showed you that one. Here's the here's where we currently are for the S&P and for the NASDAQ. Again, this is in the newsletter, so you can just download it and look at it if you want to. The green line is where we are right now, and the blue line is the reconfigured taking 2020 out. So it's much flatter now, starting in March, a little bit of a decline, and then it sort of goes sideways all the way till June. And then we get another sideways movement just before the election. And then after the election, the market gets to a new high. And interestingly, taking 2020 out, the black line is with 2020, the COVID crash. The blue line is without the COVID crash. They both merge and get back to the same point by the end of the year. Same thing with the NASDAQ. NASDAQ has a little more of a decline in March, but then it kind of goes sideways again until June. So just things to watch out for. What else do I have? This one here was interesting. The truth chart in VectorVest changed. It was bull market thrives, and then it was rarely happens, and then now it's bull market ends. So we'll see if the next thing is a bull market begins. I mean, it could go back up again, but interesting that that occurred. And then this one here is the inversion, which I've talked about before. Recessions don't happen when there's an inversion. Recessions happen after the inversion uninverts, which is exactly what this says up here. And the Fed starts to cut rates. So those are two of the three things that I look for in my recession watch. I look for the uninversion of the yield curve. I look for the Fed starting to cut rates, and I look for the unemployment rate starting to spike. Those three things happen before a recession. None of them have happened so far. And then this is the risk on, risk off chart, which basically shows the S&P, stocks versus bonds, investment grade. Everything is kind of flat right now. Stocks versus bonds, stocks are doing well. S&P is going up. High yield bonds versus 3 to 7 year it did break out a little bit, but now that's kind of flattened out. Russell growth versus value broke out, and that's kind of flattening out. And consumer discretionary versus staples still has not come back to a new high. So everything is just sort of treading water right now, waiting for perhaps that CPI number, which comes out the week after next, just before the next Fed meeting. I'll talk about that next weekend. So anyway, for today, the last thing I'll show you is just an update on this market timing strategy, which I've talked about before. Had a good week in the market, of course. So QLD, since 3/13, we're coming up on a 1-year anniversary of the buy signal for this. It's up 116%. And this is updated every day. So if you participate in this strategy, which is just one ticker, or if you want the S&P that's SSO, or you could do both, or you could do the triple. That's the double leveraged triple Q. You could do the triple as well. Works the same way, and the signals are basically the same. But this shows you what the trend is, and right now everything is bullish. When the early signal turns bearish, and I'm going to explain that in the next session when I talk about my indicators, and then the short term turns bearish, that's the time when your antenna should start going up. And instead of looking at the long term, which right here, there's the buy signal, and it still has not given a sell signal, even with this big downtrend right here. But if those things start to change to bear, short term, and especially if the midterm turns bearish, if you get 3 bears across the board there, then you might start looking at the daily chart, because that gives you signals much quicker. And then you will be able to perhaps get out, or at least move to cash and see whether the market's going to stay up or begin to go back up like it did right here back in January. These are the indicators I'm going to talk about in the next session. So I'm going to leave it at that, and I'll explain what some of these, why I use them and what they are, and how you could potentially use them. There's lots of indicators, so everyone has their own personal favorites. This is basically the setup that I've come up with after 20 years of playing around with technical analysis. This is the one that works best for me. So I'm going to explain how all of those components work in the next session. So that's it for today, I think. If we look at sectors right now, utilities are bearish. The real estate beginning to turn bullish, still has 1 bear, but everything else is pretty bullish right now. XLP starting to turn bearish. And then at the bottom is the Magnificent Seven, and you can see Apple. Apple, interestingly, got an early warning bear, even though it already had a short-term and a medium-term bear. It got an early warning bear on Friday. This is something, I was watching this, and there was a really good technician that worked for VectorVest called Dr. David Paul. He passed away last year, unfortunately, but I've learned a ton from him. And one of the things I learned is something called a Wyckoff spring. And that's when you have the support. I'll just do a line right there. So there's the support line. You see it was resistance back here, became support right here, 1, 2, 3, 4 times, broke through support, came down on Friday, and then it started to come back up again. What this means, this is called a Wyckoff spring, but it's not valid until it gets back above this resistance line now, previous support, and starts to move higher. But essentially the idea, the concept here is that, back to the training that I've done of where the orders are, all of the buy orders have been right there. And right below that is where all of these people back here are putting their stops. So it keeps hitting this and going back up, keeps hitting, going back up. So everyone sees that as support. So they're like, well, that's where I'm going to put my stop, because if it breaks through that, then it's probably going to keep going and I don't want to be in it. But the Wyckoff spring says if it breaks through that and doesn't go lower and instead starts to turn back higher, that means this whole candle right here and maybe the next one, their whole purpose was to take those stops out. So market makers can see all of the stops down there. They're going down to take them all out to replenish their inventory so that they're ready for a buying streak. That doesn't mean it's going to happen. I'm just pointing this out because this is a textbook Wyckoff spring if it gets back above this support line. So we're going to watch this on Monday. If that happens, then I expect it to probably start to move higher. It's got quite a bit of resistance to get through. But it was really interesting seeing what Dr. David Paul has taught his students for quite a while. It's a textbook example of it. And actually watching it in real time is going to be really interesting. So keep an eye on that. All right, so that's it for today. I'm going to end it there. Again, if you are interested in my newsletter, just go to breakpointtrading.net. You can click on it there and get the newsletter each week, or you can register your email and get reminded that it's out there. That's it for now. The next session, I'm going to explain some of my indicators, how they work, and how you could use them. Thanks a lot for listening, and I'll talk to you soon. Have a good week.